Welcome in, everyone. I'm Zach Thomas with Growth Horizons Wealth Management. We are super excited to have you a part of our 12-part series for small business owners. Today, we're going to be talking about cash flow with James Rinn. Super excited to have James as a part of the conversation today. We're also going to have a little bit of time for some Q&A at the end. So if you find the comments box over to the top right, please make sure that you're dropping any questions that you have, and we'll make sure that we get to those at the end of our conversation later today. Next month, we're going to be having a conversation about how to navigate business loans, getting approved, and hopefully allowing you the opportunity to grow with Alan Alanis at Frost Bank. So definitely don't want to make sure that you don't miss out on that conversation. Super excited to be able to introduce James Rinn as part of our conversation today. James has over 30 years of experience working as a CFO and a COO at a number of different organizations. James lives here in Austin. He's super passionate about empowering business owners to build a lasting financial stability, and he currently runs Rinn Consulting. We're super excited to have James as part of the conversation today. Hey, James.
Good afternoon. Thanks for the kind introduction, Zach. I feel a little older now, but I appreciate the kind words.
Absolutely. Well, we think this conversation is a really big deal. For those of you who don't know, 8 out of 10 small business owners don't make it as a result of some sort of poor cash flow planning. And so we really hope that you walk away with some action items that you can implement in your organization that allow you to just have more success whenever it comes to hopefully an exciting topic, cash flow. So as we kind of switch gears, James, would love to just kind of pick your brain a little bit on maybe some of the pitfalls that a lot of business owners have whenever it comes to cash flow planning. So I know that one of the big things that I see time and time again, especially with budding entrepreneurs, with growth-oriented organizations, is revenue equates profitability, or revenue equates cash flow. And so we'd really love to just kind of hear from your experience. In the 30 years that you've been doing this, can you kind of walk us through how you've seen some of these small organizations just think about cash flow, maybe from an unhealthy standpoint in terms of equating, well, we're continuing to grow top line or growing revenue, but not necessarily understanding how that impacts their cash position and also the profitability of the organization.
Yeah, appreciate that, Zach. And I do think that's a common issue. If you set strategic goals, it's around revenue, it's around profitability, it's around M&A transactions, and rarely is kind of cash and liquidity kind of on the dashboard, so to speak. And so, but CPA kind of GAAP financials are important, and revenue is important. But if we don't ultimately turn that revenue into cash that, pays payroll, rent, utilities, et cetera, then it's kind of all for naught. And so that's why I think, the IRS, whether you like them or hate them, that's why a lot of taxpayers are cash-based taxpayers, because if it doesn't turn into cash, then, there's nothing of true value to ultimately tax. And so it really is unfortunate situation where so many small business owners focus on revenue growth as opposed to that revenue turning into cash.
Are there any examples that you can think of from your time in the industry where you've seen like really strong growth-oriented organizations just have like poor cash flow, and what have been some of the repercussions of how that's impacted the organization?
Yeah, I think in seasonal businesses, and we'll talk a little bit about that during our time together this afternoon. But seasonal businesses are often have those issues. But I think professional services firms and service firms a lot of times, they bill late. Attorneys are the worst. They bill 3-6 months later, and they're having to pay draws for their attorneys, pay salaries for their admin staff. And so they get behind on billing, then they're behind on collections. And so they're, financing all the work of their clients. And so I've seen, time and time again, missed opportunities to bill earlier in the process, to collect earlier in the process. And so because of that, they look up and then they're all of a sudden behind and cash flow is tight, and do we have a line of credit or not, and can we draw on it or not? And so it's a little bit too late sometimes at that point.
Yeah, that's really good. Do you find that there's, I guess, differences from a cash flow planning standpoint on an industry by industry basis? You know, does a contractor need to think about their cash flow different than a service oriented business like an attorney or like a dentist office? And if so, what are some of the differences in the way that, on an industry specific basis, you know, small organization owners can, you know, think about how to, you know, cash flow?
Yeah, there's definitely unique attributes to those. Like you mentioned dentists, you know, the billing cycle and the collection cycle, you know, for dentists because of insurance is much prolonged. And so you have to plan accordingly for those. And so you may need, you know, a greater buffer for industries like that. I think services industries are generally similar, where you have seasonal businesses where, you know, 75% of their revenue is in Q4. You know, they need to plan accordingly for some of those cycles. And if you miss kind of revenue targets, you know, understanding that's going to have implications down the road for the business. And so industry groups definitely are unique. And so that's why I think you just need wise counsel, either from your, you know, CFO, fractional CFO, someone who can advise you on what historical data trends have been so you can plan accordingly.
Yeah, it's really good. So I want to dig in a little bit more because this is another common thing. It's not as sexy or as fun to, you know, talk about as cash flow planning is. I find that most small business owners, if you bring up the concept of cash flow, they're at least amenable to the conversation. When we start
Mm-hmm.
getting into financing terms with vendors, it just
Yeah.
seems like people are ready to go to sleep. Oh my gosh, I don't want to talk about net 60 or net 90, but I
Mm-hmm.
do think that it's a trap that I see, especially with a lot of the organizations that we work with, primarily a lot of contractors who, you know, they have their fixed expenses, they have payroll that they have to make. You know, they're buying equipment. They're, you know, constantly having cash come in and out the door,
Mm-hmm.
not paying close attention to the way that they're managing their vendors, but also
Mm-hmm.
how they're managing their collections
Right.
with their clients. And I find that that can be a really pivotal, um, you know, way of maximizing your cash flow position is trying to get the
Mm-hmm.
best financing terms that you can with your vendors, especially the
Mm-hmm.
vendors that you're doing a lot of business with. Specifically for me, it's contractors who might be
Right.
buying hundreds of thousands or millions of dollars, you know, worth of um, supplies, you know, goods to, you know, basically build out a house or whatever it looks like, and
Right.
then just dragging their feet on collecting from, you know, clients after the work has been done. So can you maybe
Mm-hmm.
talk through, like, how have you seen organizations that you worked with? Have you seen that maybe manage it not so well, and then, you
Mm-hmm.
know, how have you seen some of these organizations manage those, you know, well?
Yeah, and I think, you know, as it works out, a lot of companies that are more established, you know, they're 30-year-old companies where this is kind of the way we've always done it. You know,
Hmm.
we always, you know, have bill our clients, they can pay within 60 days and everything's good. It's like, well, why did you establish that? Well, that's the way we've always done it. It's like,
Sure.
well, does that work for the business?
Hmm.
Is that okay that you would cash flow, you would, you know, pay your staff and they would, you know, pay you for those services 60 days later? And so once you kind of process with business owners that, you know, maybe that's not the industry standard today, or that doesn't need to be the industry standard today, you're providing an excellent level of service and you should be paid timely for those services. And so, you know, professional services firms, some, you know, will bill and it'll be net 30, some will bill and it'll be payable upon receipt, and some will be, okay, when you want your tax return released, you need to pay today if you want
Yeah.
your tax return today. And so I think just rethinking the why,
Hmm.
and then thinking about what is possible, and if you have customers that are trying to push out their payment further and further down the road, maybe they're not the right customers for you. If
Yeah.
you have the ability to to thin certain customers so you can get, better customers, something to consider. And then on the payment side, I think, trying to work the best payment terms that match the cash flow of your business, to the extent possible. If you buy this inventory today, it's not going to turn into cash to you for 90 days. Try to work those to where they coincide, where you're not having to be the bank on financing that transaction. And so I think it's, a lot of common sense things, but things that business owners, when they're running fast, trying to grow revenue, grow the business, don't, take a step back and say, how can we make the process more efficient? How can we make it better for us from a cash flow and operations perspective?
How often should I guess whoever's in charge of, financing terms or accounts receivable, how often should those terms be reviewed, either, from a vendor management standpoint or in terms of, collections with clients? Is that something that, should be discussed every 12 months? Is that something that should be talked about every 5 years? Maybe for some people, it's like, 30 years since the
Yeah.
last time that you thought about this. Like, what's
Yeah.
the best practice in terms of how
Yeah.
often should we be thinking about this?
I would say a general rule of thumb, and again, this is a general rule of thumb, would be, at least annually.
Mhm.
If you have kind of annual engagement letters, annual contracts, review those payment terms as you send out your annual engagement letter renewal. Some are obviously on auto green, and but you should review those annually and say, these auto green, we need to tweak those. We need to have auto debits of their accounts, on a monthly basis where we know we're getting paid timely. And so I think at least, if not annually, every couple of years at
Mhm.
the longest.
That's good. Are there any other common pitfalls that you can think of from your experience? Just I guess normal things that you've seen along the way that are maybe not healthy to a growing organization whenever it comes to cash flow planning?
I think timeliness of billing is
Mhm.
is really important. I'd say, if you can bill in advance and be on a retainer, that's kind of best case. If you can, bill, timely, the first day of the month, if you're billing, if you complete the activity, sorry, if you complete the activity, mid-month, that you would bill mid-month, so that you don't wait 2 weeks to bill and then, kind of continue. And so to the extent that you can have, timely and efficient billing processes, that'll go a long way in supporting and reducing your DSO, your days sales outstanding. And so I think continuing to look at that process, will be helpful. And then I think on the financing side, if you do have an inventory based business, understanding how you might be able to leverage an ABL, an asset based line, kind of a working capital line, for those type purchases where it doesn't, impact your ability to pay your employees and meet the immediate needs of the company.
Yeah, it's really good. So why don't we shift gears a little bit, and we've talked about maybe some of the pitfalls where we've seen things go wrong. Why don't we shift gears and talk a little bit about where we've seen some of the clients that we've worked with over the years do things right. And I know that there's one instance that comes to mind for me. I have a client. They own a manufacturing company. Family owned business. They have about 20 employees or so. And when we first started working together in 2022, we had a conversation about setting up a captive insurance company. I know,
Mhm.
James, you're familiar with captives, but maybe not everybody on the call is, because it's kind of a less common, strategy that people are utilizing. Really cool the way that it works. It allows the operating entity to be able to take cash off the table and move it over into a separate insurance company. So the operating entity gets to write that off as a tax deduction. And then that was in 2022. In 2023, this client unfortunately had about $1 million loss from a client that did not pay and was continuing to promise to pay. And as you can imagine, the collectibles continued to increase and increase and increase until it just became untenable. And unfortunately, we wrote that off as a loss in 2023. And the great thing about the captive insurance company is it allowed them to be able to pool those premium dollars and move it back over into the operating entity. And they were able to do that in a tax-free exchange. So they get to deduct it in 2022, move it over into the insurance company. And then they filed an insurance claim with the company that they owned and moved that cash back over into their operating entity. So anytime I'm having a conversation with maybe a more mature organization who is maybe a little bit cash heavy, because we've been talking about cash deficits. The other side of the coin with cash flow planning is you don't just want to be sitting on millions of dollars of cash, and just putting it in a CD or a savings account, not having it work for you. And so this is an example of an organization that was able to leverage getting those funds off the books in a year where their tax bill is really high, and they able to swap it back over in a year. And because they wrote off that $500,000 expense, it reduced their taxable income pretty significantly. Plus, they got that cash infusion back in. So that's one of the examples that I can think of that was a really big win for us, over the past couple of years. Are there any examples of clients that you worked with or that you can think of where you've seen cash flow planning done really well, especially in those instances when things are not going according to plan, things are not going according to our projections or expectations, and now hopefully we've had a plan that we've put into place, and now we get to execute on. Are there any examples that come to mind for you?
Yeah, I think captive insurance is it's a more progressive kind of idea, but it can be used for receivables, it can be used for warranty, it can be used for a number of risks that the organization needs to plan for. And so it can be a great tax planning strategy and cash flow strategy, as you spoke to, Zach. So I think that's a great example. I think a lot of it is around just planning for the unexpected, and some of that is around receivables, but risk mitigation that can impact small businesses, that can be part of that statistic where only 82% don't survive and continue in perpetuity. And so you want to avoid being that. And so I think it's setting aside funds for kind of near-term needs as well as longer-term needs, either in a captive setting or otherwise. And so I think there's tax advantageous ways to do that, and then there's other more kind of blocking and tackling ways to do that aren't captives require a little legal work and other work and experts to come alongside you in those.
Yeah, it's really good. Are there any examples that you can think of where there's been an organization that was maybe growing really fast, struggling with cash flow, and you were able to come alongside them and help them just kind of iron out some of the kinks in their plan and allow them to kind of smooth out, from a cash flow planning, standpoint? We've talked about some of the tools that could be used, like, negotiating financing terms and collecting payments, in a timely manner, and leveraging, things like lines of credit. So are there any examples that you can think of where maybe things weren't going according to plan and there were maybe some pain points, but ultimately a plan was put into place and it allowed things to kind of get smoothed out over the long term?
Yeah, it's a lot of times it's not overly complicated. It's just about really good execution on collection efforts, on monitoring cash flow, having kind of daily cash flash. How are we doing? And so if you're doing daily cash reviews, then you're probably in kind of a red zone, if you will. There's kind of green light, yellow light, red light. But I think it's, about, the discipline of how do you execute kind of week in and week out. How do you do the things we've talked about previously about, billing in advance, billing timely, collecting timely, and then managing your receivables, or I'm sorry, your payables, on the mission critical ones. You don't want to string out and take advantage of your vendors, but trying to negotiate some of those favorable payment terms for your organization. And so I think it's about just being kind of forward looking as it relates to cash flow, and staying on top of the details.
Yeah. Can you speak to asset-based lending or lines of credits a little bit? We kind of breezed over that.
Yeah.
I find that that's an often overlooked
Mhm.
topic with a lot of the companies that we work with. It seems like people tend to fall into one of two different categories, and maybe this is just my anecdotal experience,
Yeah.
but it's either like we're debt free, we are pro Dave Ramsey. We don't want to have anything to do with debt, right? And so like we know what a line of credit is, but we're not really interested in it until that thing happens. And
Right.
then we can't make payroll. And then, oh my gosh, now we're going to scramble to find, how to get, access. Or the other end of the spectrum is maybe somebody who leverages their debt a little bit too much,
Mhm.
and it constantly puts them into a crunch position anytime things are not moving according to expectations. So could you talk a little bit about the benefits and maybe the healthy way to use things like a line of credit for small business owners?
Yeah. I mean, I think it's prudent, maybe even a best practice for small businesses to have a line of credit or an asset-based line of some sort.
Hmm.
If there are unexpected events that require it, and it's harder to get it when you need it. It's easier to get it and acquire that for the rainy day, the difficult challenge that you come across where you do need to draw on that line. And so I encourage my clients and my employers previously to get those line of credit in place. You don't have to, get a huge line, but, a prudent line that would be, a month's capital or, half a month's capital to help you pay payroll and those kind of things. And, my last employer had a line of credit for 5 years. They didn't draw on it once, but it was there if they needed it. And so I think that gives owners peace of mind knowing that's in place. It's not overly expensive, especially if you have good banking relationships. You can get a lot of those fees and originations kind of waived or cut down, but it'll be good peace of mind in the event that you need them.
That's great. One of the things that was brought up a little bit, and we kind of glazed over it, and I know that you one of your areas for Rinn Consulting is doing fractional CFO work.
Mhm.
I've noticed over the past couple of years that term has kind of gained a lot of traction.
Mhm.
And I find that there's a lot of confusion with small business owners in terms of like, what does a fractional CFO mean? How is that different from a bookkeeper or an accountant or a
Mhm.
tax preparer or an enrolled agent? Could you provide a little bit of clarity in terms of like, what's your definition of
Mhm.
the role of a fractional CFO, and how does that differ from maybe the experience that a small business owner has with an accounting firm or a bookkeeping firm?
Yeah. I mean, you and I both have the pleasure of providing these services to clients. And, the way I view it is, bookkeepers and accountants, you need those people kind of staying on top of the day-to-day details of debits and credits and reconciliations and closing the books. Fractional CFO, provides kind of higher level, kind of strategic insight, related to driving the business, profitability of the business, strategic execution. And so a lot of times small business owners may not need a full-time CFO, but they need a C-level finance person, at some, 10, 20% time. And you can get kind of the most valuable parts to you in small increments, and you can kind of buy as you need. They can do special projects from time to time, help with M&A transactions, help with exits if you want to sell your business. And so it's a little bit of this is probably a poor cliche, but kind of a hired gun to help, in time of need, as the company grows and executes on its strategies in the future. And so it can take on different forms. I know you do different projects for some of your clients than I do. But I think, having a senior kind of finance person in your court is helpful for a lot of small business owners. And I enjoyed coming alongside business owners and helping him or her kind of accomplish their goals.
Yeah, that's great. Why don't we shift gears? And we've talked a lot about concepts and some really high level things. I think it's been really good. I find myself anytime I'm listening to something like this, wanting something tangible that I can go and implement, in my business. And so I know that through the conversation, a couple of things that have really stood out to me in terms of just starting to think about putting a plan into action is thinking about how to just strengthen your finance terms, how
Mm-hmm.
you collect with your existing customers, just being able to bridge the gap between what's going out and what's coming in. So
Mm-hmm.
maybe for some people there's a conversation that needs to be had in terms of, hey, we haven't really revisited a conversation with one of our key vendors in a long time. Maybe we need to go have that conversation and see if there's a way to have more attractive financing options. Maybe we can kind of stretch things out, and then
Right.
maybe we need to close the window or refine the process a little bit with some of the clients that we're working with, so that way we're not having to constantly chase those dollars as much.
Mm-hmm.
One of the things that we didn't dig into too much, but I think is really important, is building a cash reserve.
Mm-hmm.
It seems like there's typically some best practices whenever it comes to building a cash reserve. What do you typically recommend for small business owners in terms of how to think about their cash position and how much they should have set aside for a rainy day?
Yeah. I think, as you and I talked about before, I think industry does have something to say, and will give you kind of additional guidance on what's helpful and what's necessary, depending on kind of the peaks of your cycles and your revenue stream and cash flow stream. But I think generally, kind of 3 to 6 months is a good rule of thumb. If you're less than that today, I wouldn't necessarily be alarmed, but if you're having profitable growth, sometimes you'll be making investments in technology, investments and other hard assets, soft assets, and that you may want to separate kind of those buckets, if you will. But I think if you can get to 3 to 6 months, I think that's generally a healthy place to be. Have that line of credit that we talked about before as kind of a backstop. If you were to head in the other direction, I think that'll give you peace of mind. And I, quite honestly, if you are transparent with your employees and they know the financials and they see low cash, that will say, oh, we're gonna have a problem meeting payroll. And so I think give your employees, to the extent they have visibility into your financials, peace of mind as well.
Yeah, it's good. Um, Also, I think something that's really important is, maybe once you get a couple of these lower hanging fruits out of the way in terms of, setting up the line of credit, building your cash reserve to 3 to 6 months, tightening up your, financing terms and your collectibles, is starting to think about maybe not so much retroactive what's happened in the past, but starting to
Mm.
plan for in the future. And so, two steps that I think kind of combine hand in hand, that we would hope that people watching today would be able to implement, is starting to think about how to forecast for future growth. And
Mm.
so, whenever you think about forecasting, what does that look like for you in practice,
Mhm.
and how often should small business owners be doing some sort of cash flow analysis?
Yeah. I think there's traditional budgeting, and then I think, as you're touching on, the cash flow aspect of that as well. I think, having good historical data, helps inform kind of the prospective and forecasting data. And so I think, looking back on what cash flow was, both from an inflow and outflow perspective this time last year, how are we tracking against that? What are the reasons we're either behind or ahead of last year? What are the implications for the next quarter? So I think you should have a rolling kind of 3 months, 13 weeks forecast, and then continue to keep that fresh as you kind of roll throughout your year. And then, where you do deviate from your forecast, begin to get down to why, not just, hey, we're short, but, is there something broken with our collection process, with our billing process, with client relations? What's the issue that we need to get to the root cause of? And I think sometimes they just say it is what it is, but they don't, take time to get to the root cause, and that will help you if you can get to the root cause sooner than later.
Yeah, that's really good. I know that as it relates to cash flow planning, where I find myself positioning, with the clients that we help them out with fractional CFO work is there's typically, a visionary that has gotten the organization to the point where it makes sense to bring us in. They're really good at developing growth strategies. I find that we can typically come in and we can help complement by saying like, hey, these are the 5 things that you said like we would really like to focus on. I find that being able to pair the growth strategy with cash flow planning allows us to be able to start to prioritize what's the highest objective. And a recent example is a contractor that we work with who has had some on and off successes with scaling up their organization.
Mm-hmm.
In 2023, they hired and fired about 30 employees, and they ended with just the 2 owners at the end of the year. And so we were brought in after that to help them think about really refining their processes, so that way, hopefully, they don't have to go through that experience again.
Right.
And they had some conflicting priorities that I found as we were developing their growth plan, also mirrored with the cash flow planning that we were doing, which was developing real estate and also growing the operating entity itself. And so we had a lot of conversations around, hey, we can do anything, but we can't do everything. And so if we have to choose between these 2 things, which one is the highest, priority?
Right.
And we were able to, define, hey, doing the real estate development for this next stage of this property that we're developing needs to be the short-term priority, because we've already taken out some loans to make sure that this thing gets completed. So we really need to make sure that we're building this thing out, so that way, hopefully, we can get some rental income that's going to service the loan, compared to investing a lot of cash into hiring more people and ramping up and scaling up the operating entity. And so we had that conversation in October, November of last year. And so fast forward to where we're at right now. I'm really grateful that we were able to have that conversation, because now, with where we're at, um, there's been a finite amount of cash to be able to fund both of these objectives. And
Yeah.
so we were able to revisit the conversation and say, hey, do you remember that conversation we had 6 months ago about what's the highest priority? Well, like, this is what we talked about, was getting the real estate developed. So here's what it's going to take for us to be able to finish this out. And then we can go back to scaling up or ramping up the operating entity. So in your experience, I guess, what does it look like in terms of pairing the cash flow planning that you're doing as the CFO with the visionary aspirational goals, of the leader of the organization, whether that be the CEO or CRO, of the organization? What does it look like to be able to mirror those 2 things to where they don't butt heads with each other, but hopefully they integrate together? What does that look like for you, James?
Yeah, I think, if you can do kind of the cash flow planning, determine what the return on the investment is, or the payback period for the investment, I think that's helpful, especially as you have competing priorities. In the example that you kind of shared, Zach, is many times in life as small business owners, you have these competing priorities. And so how do you put dollars where you're going to get the fastest payback period, or you get the highest return, so then you can reinvest in the next growth initiative that is important to the company. And so I think, as opposed to kind of just doing it on the back of a napkin, and try to be a little more precise, put more thoughtful review and analysis of what is. I mean, you're making big bets at times as entrepreneurs, and so how do how do you make those wisely and with wise counsel, and not with kind of pie in the sky forecast from a, sales guy, chief revenue officer. Not that those are, bad guys and gals, but, sometimes they're optimistic, and we want to have realistic goals that we can execute on as businesses and business owners.
Yeah, it's really great. As we transition over to questions and answers, so we do have a question from Chris here in a second that we'll get to. Want to definitely make sure that we highlight James with Rinn Consulting. James was gracious enough to put together a free strategic plan review. So if you have some of the gears that are spinning in our conversation today, and you have some questions around, hey, I'm having some of these pitfalls in my business or in my organization. Maybe I need somebody to kind of help me soundboard some of these ideas and think through putting a plan into place. James has been gracious enough to allow the participants today to be able to take advantage of a free review session. So make sure that you check out his website. You can see a phone number listed there. Transitioning on to one of the questions that we have, James, maybe you want to take this one. Chris asks, are there any insights on cash flow for small nonprofits? And then what are some of the best practices that you've seen be effective for cash management for small nonprofits, compared to, we've mostly been talking about for-profit organizations at this point?
Yeah, that's great. I have a heart for not-for-profits. I've served on not-for-profit boards and audited not-for-profits, and I think that's a great question. And I think the same kind of savings rules of thumb I think apply, that not-for-profit will want to have a prudent amount of savings and cash reserves. And then I think a lot depends on your sources of funding. Are they grants? Are they, individual donations? Is it year-end giving that drives a lot of the ministry efforts of the not-for-profit over the course of the year? And understanding if you don't hit your year-end mark, what are the implications for the ministry? Do you have a contingency plan in those situations? And so, it's complicated. It's difficult, but I think with kind of wise counsel and kind of the leadership of the not-for-profit, kind of discerning what's kind of a base case that we can build a budget off of. Hopefully, not-for-profit income exceeds that, and you can expand some programs and do some things, but understand that a lot of times you don't have a very steady income stream for not-for-profits, and being able to hopefully have contingency plans that can scale up or down based on donations, grants, and so forth. So I appreciate the fact that you're in that not-for-profit space doing good work, and happy to talk offline if that's helpful as well.
Yeah, thanks, James. Just to reiterate some of the sentiments that James was sharing, it's been my experience here recently with the nonprofit board that I sit on. We've been able to kind of create 3 different scenarios whenever it comes to budgeting. So it's like, here's our break-even analysis. Like, if we want to make sure that payroll goes off and all the lights are paid, like, here's really what we need to be to make sure that we're paying all the bills and not letting go of any of our employees. And then we typically have on the other end of the spectrum, like, hey, if we just knock it out of the park and we get all the donations, before the end of the year, here's what we would expect from more of a growth oriented standpoint. And maybe there's some larger initiatives or some future hires that we want to be able to take on that we'd love to be able to budget for. And then we typically, try to find the average between those two. And that allows us to kind of have some wiggle room in the plan to say, okay, to go back to the competing priorities, conversation, especially, in the nonprofit space, where I think it's even more difficult than being a small business owner. A lot of times you have all of these conflicting priorities in terms of things that you would love to do. But at the end of the day, just being able to prioritize, like, what's the most important thing. I find that middle case allows us to have a really well-informed conversation around like, okay, here are the mission critical items to make sure that the organization continues to run. Here are the things that we would really love to do. And so, what's the middle ground in between in terms of, okay, maybe we can't hire the next 3 people, but maybe we could hire that one person, and maybe we could start that one new initiative that we wanted to, instead of being able to do all the things. And so that's been my experience in terms of just being really thoughtful in terms of cash flow planning, because I know you have a very small window from like Thanksgiving to really end of the year, where it seems like the majority of the cash is going into those nonprofits, and so that can make it really challenging when you're trying to do planning in advance, because we also know like there are going to be things that pop up throughout the year as well that we need to make sure that we have some sort of cash reserves or contingency plan for as well.
Yeah. Adding to that, Zach, if I can,
Mhm.
one of the not-for-profits I've set on the board, they had monthly donors, and then they had folks that gave, kind of year-end donations, and they, early on were like 75% year-end, 25% kind of monthly donors, and so one of their strategic items was to move more of their donors to monthly giving. So it was a little more predictable, less dependent on year-end giving, and they still hope they had great year-end giving. And so I think that does help in some of the planning and prioritization that you referenced, Zach. And I'm sure it's something, not-for-profits kind of work through, but I think having plans to transition from one funding model to another over time is helpful.
Yeah, that's great. Well, as we wrap things up here in the next couple of minutes, want to just remind everybody that next month we will be having a conversation around navigating business loans. So if you have questions around, how to get approved for that loan, or you're thinking about doing that development or expanding the team, we're going to be bringing in Alan Alanis from Frost Bank. So here's a QR code that'll bring you to a landing page. That will allow you to, get registered for the webinar in the same way that you registered today. As we wrap things up, James, what would you say, from our conversation today, if you wanted to encourage, the leaders of, these small organizations that we've been talking to today, if they were to walk away with one actionable, item from our conversation today, what's sticking out to you the most from, what we've from the vast array of territory that we've talked about?
Yeah, I would say, having a early indicator dashboard,
Hmm.
whether it be kind of a flash, whatever the case might be, let it not be just revenue and net income, but some key dashboard items related to cash flow, where you catch things early and can pivot accordingly and take necessary corrective actions. And so nobody wants to be surprised. Cash is king. Need to make sure it's in a good place, so that these organizations can sustain their successful path forward.
That's great. Well, thanks so much for joining us, James. We hope that the information was really beneficial for everybody. Thanks.
Thank you.